Hi guys, welcome back to another market recap for the month of February. We're going to be looking over a couple of things. One is the global chaos that we're seeing as a result of a lot of the Trump administration's moves. But I think what I want to focus on today is the beginnings of underlying weakness that we're seeing in the US economy. So stick around. We're going to go through some important key dates, and we'll see if we can learn anything about where the market's going to go in March. So straight off the bat, you can see here on my screen, we're looking at the DXY for the month of February, and the US dollar started super strong in February. And this is off the back of Trump's tariff comments that he made at the end of February, where he threatened 25% tariffs on the US's neighbors, namely Mexico and Canada. As everybody knows, Mexico and Canada managed to negotiate their way out of those, though tariffs are beginning to rear their head again, just in the last couple of days as we finish up the month here. Other than that, it's been a remarkably tariff-free month, strangely. So we're going to look at some important events that occurred, and then we'll see how the market responded. And again, we'll bring that focus back to underlying economic weakness in the United States, exacerbated by Trump's chaotic moves. Not necessarily chaotic moves. He may be probably very well-planned moves, but that they are bringing an element of chaos to the markets, unpredictability to the markets. We're not going to focus too much on the geopolitics, so we will have to touch on it. And but mainly we're just going to look at the dates. So straight off the bat, the first thing that we want to talk about here is obviously after the tariff talks here at the beginning of the month was the non-farm payroll that came out on the 7th of February, Friday the 7th. Now, this came in weaker than expected at 143K versus 170K, and then well down from January's figure of 307K. But we still saw growth. We still saw a price increase for the US dollar. And you can see here on the DXY, we can see there was a spike. And this is because traders believe there's not too much to move the needle, the 143 versus the 170. And in with this as well, there was underlying wage growth that we saw, and a surprise increase in wage growth. And that, I think, probably gave the Fed more pause than anything else, because in their struggle to control inflation, while the 143 versus the 170 figure, especially off the back of a 307K in January, that's not a big deal. But increased wage growth is certainly an issue there. But then on Wednesday the 12th, we saw that inflation came through higher than expected. And this is when people started to think that maybe things might be a little bit different. We saw headline inflation increase. We saw core inflation increase. And this is when people started to think that maybe we're looking at a slightly different issue here than previously. And this was exacerbated by retail sales, which were published on the 14th. Here we saw retail sales come through well below expectations, and this is minus 0.9% versus minus 0.1% expected. So all of these things are beginning to add up here. And then on the 19th of February, we saw the Federal Reserve release the minutes for their January meeting, where they made it very clear they're not in any rush to cut interest rates. And they specifically targeted, well, they didn't specifically target, they were actually very diplomatic in their language. They were talking about Trump's moves, especially vis-a-vis immigration and trade, or as shorthand for tariffs. Participants indicated that provided the economy will remain near maximum employment, they want to see further progress in inflation before making additional adjustments to the target range for federal funds rate. In particular, participants cited the possible effects of potential changes in trade and immigration policy. And as we can see here, the DXY responded, came up a little bit, not a huge amount, but it does mean that people are beginning to think that the Federal Reserve beginning to consider that Trump's trade and immigration policies are going to force the Federal Reserve to keep interest rates higher for longer. But continuing the theme of underlying weakness, we then saw on the 21st of February, we saw that existing home sales unexpectedly came down 4.9%. And this is all beginning to add up. And then this is when we began to see the stock market take a beating as well. We can see here, this is the Wednesday, this is the FOMC minutes when we're looking at the S&P 500 index here. This is when the FOMC minutes were released saying that they thought interest rates were going to stay higher for longer as a result of Trump's trade and immigration policies. And then on Friday, we saw the existing home sales. And this is kind of the straw that broke the camel's back when it comes to equities. We can see here that the S&P 500 has had a very poor few days as a result of this. And so we're seeing here a theme of underlying weakness. And we see here today, I'm recording on Tuesday, the 25th of February. We've been seeing a slide in the US bond yields, and it's putting a lot of pressure on the dollar this morning. As a result. And this is all this data that we're seeing coming out of the United States showing weak consumer and business sentiment. How does this tie into the Trump administration? Well, it's quite simple, really. I mean, investors like predictability and they like stability, and we've had anything but now for the last 2 months. We've had a lot of talk. We've had a lot of plans that Trump has initiated vis-a-vis tariffs and trade that have not come to fruition. And so when, one moment traders and investors are trying to process the impact of a 25% tariff on Mexico and Canada, and then that rug is pulled out from underneath them, it's very hard to make any kind of decent forward planning. When you are expecting tariffs to come through as they are, that also has an economic impact. And I think we can expect to see continued weakness in consumer and business sentiment. But all this has been very good for the gold price. Here we can see this is spot gold over the course of February. Everybody's just waiting for it to break through the 3,000 barrier now. It probably will sometime soon, especially with continued US dollar weakness. Gold is a haven, and investors are very uncertain at the moment. So it's definitely getting a boost from that. And as I said, there's been increased tariff talk again today. And Trump has put back on the table increased tariffs on the US trading partners. So this uncertainty that we're seeing is going to continue. We did have brief respite for the euro for this month. And we can see here, one thing I do want to touch on is the German elections. We saw that the center-right SPD has won the elections in Germany, and that has given some kind of stability to the euro, which is good news for the euro. One thing I do want to touch on as well here is something that I think is a wider issue going forward is the threat to US regulators. And this actually came through last week. Trump signed an executive order where he's trying to bring US regulators more closely under executive control. This didn't really spook the markets because we've had so much else going on at the time. But then today, the chief investment officer of Amundi has said that Trump's move to rein in regulators is a big mistake. And I think this is something that we as traders and we as investors really need to keep an eye on. If regulators become in the United States start losing their independence to the executive, then things can become very risky indeed. We could see huge investor flight. We could see huge unpredictability in the markets. So where do we stand going into March? Well, I think the main thing we need to think about here is nobody knows. I would assume just slightly that the dollar is going to recover and that we're going to see continued dollar strength, but not with any certainty there. I think that Trump's moves on the geopolitical stage and on the domestic stage are going to continue to create uncertainty and exacerbate this weakness that we're seeing in the United States. I think his moves on the international stage are going to continue to shake up global politics and also create further instability there. So yes, I do expect, as I said, slightly the dollar to retain some of its strength, but not with any certainty going forward. I think there are no patterns to be seen here yet. There's no patterns to be seen in the markets, no patterns to be seen in Trump's behavior. So again, for traders, look, if you're a technical trader, then you're probably thriving off this volatility. It's fantastic. If you're an investor or you're a positional trader, I think you're probably having a very difficult time at the moment. And I expect that to continue until at least for the next few months. I've always said that I expect to start seeing some kind of pattern emerge. from Trump administration's behavior and the impact on the markets sometime around summer of 2025 this year. So there you have it. That was February. Join me again next month. We'll have a look back at March.